The New Normal series by Oakworth, Part 4, Market Valuation. When trying to determine the correct valuation for stocks, analysts consider a number of different criteria. Some of these include overall economic growth, expected earnings, expected growth rate of those earnings moving forward, the predictability and reliability of the expected earnings, the overall level of interest rates, and other investment options available at the time. Overall economic strength obviously has a major impact on equity prices. A strong economy will allow most companies to increase earnings and give management confidence to grow their business. Under normal conditions, the economy changes very slowly, and we look for slight changes in quarterly economic reports to try and make sense of these slow changes and trends. It has not been difficult to see the changes past few weeks, though, however. Consider this. Over the last 9 weeks, over 38 million Americans have filed for unemployment insurance. Advanced retail sales for the month of April were down 16.4%, and the government estimates that first quarter GDP shrank by 4.6%. In truth, it's hard to find any piece of significantly positive economic data. Now, most economists will agree that the U.S. economy is going to be weak for some undetermined period of time. The length and total effect of the COVID-19 shutdown on the economy, and therefore the impact on corporate earnings, will be determined by the speed of medical solutions brought to fight the virus. The approval of Gilead's drug remdesivir as a first treatment for COVID-19 was one important step in this process. We also need to see the rapid increase in available testing in the U.S. to let us know who has and who doesn't have the virus. Most importantly, we need a vaccine to allow people to get out and return to a normal routine as soon as possible. The timing of these medical solutions will go a long way in determining the long-term damage inflicted upon the economy. Corporate earnings also play an important role in determining equity valuations. To have a starting point to discuss equity market valuation, let's take a look at the most common valuation metric used in valuing equities, the price-to-earnings ratio. The P/E ratio is simply price divided by earnings. The P/E ratio is also called the market multiple. For example, here are the closing price and earnings for the past several years for the S&P 500. In 2016, the S&P 500 closed at 2,238.83. And annual earnings for the S&P were $118.22, which led to a P/E multiple of 18.9 times. In 2017, the numbers were 2,673.61 divided by 131.46 for a P/E multiple of 20.3 times. In 2018, the year-end closing price for the index was 2,505.85 divided by earnings of 159.65 for a P/E multiple of 15.7 times. And finally, in 2009, the S&P closed the year at 3,230.78. Annual earnings for the index last year were $162.07, which led to a P/E multiple of 19.9 times earnings. So for the past 4 years, the S&P 500 finished the year with a market multiple of between 19 and 20 times earnings, with the exception of 2018, as we had a dramatic, well, at least at the time, decline in the S&P 500 for the fourth quarter of that year, which gave us a lower market multiple of 15.7 times earnings. Over that same 4-year stretch, earnings were growing at an annual rate of 8.5%. For comparison, from 2012 to 2015, the S&P 500 traded with a lower average multiple of 16.3 times earnings, with an annual earnings growth rate of only 4.2%. The index traded with a lower multiple, in part due to lower earnings growth. In the corporate response to the new normal, we discussed how several factors will make it difficult for the S&P 500 to grow earnings at the same rate as it's been able to do over the last 5 years. Fewer share buybacks in order to strengthen corporate balance sheets and pressure on margins, and almost all businesses should put a drag on the market multiple we place on expected earnings down from the 19 to 20 times we have enjoyed for the past several years. Most investors have heard the phrase, "the markets hate uncertainty." Well, uncertainty in future earnings leads to a lower market multiple as well. Historically, large cap stocks are rewarded with a higher multiple than small cap stocks, even though the earnings growth for large cap stocks will typically be lower than it is for small cap stocks. Why is this? The quick answer is the earnings of large companies are more predictable than their smaller peers. For example, Intel has 39 analysts covering the stock, and there will be very few, quote, surprises with Intel's earnings announcements. A small cap semiconductor stock may only have one or two analysts covering it, with a wide range of estimates for their earnings. Even though Intel has an expected long-term growth rate of 7% versus 15% for most small semiconductor stocks, Intel will be given a higher multiple for the perceived less risk with their future revenues. However, with the COVID-19 economic shutdown, even the largest corporations have very uncertain earnings for the next several quarters. That uncertainty will bring downward pressure on market multiples. We started this year with S&P 500 expecting to earn $177.25 in 2020 and $196.13 for 2021. As we are just about finished with first quarter earnings, the expectations for earnings have as expected, fallen dramatically. We now expect the index earnings for 2020 and 2021 down to only $127.68 and $163.75, respectively. The problem is we're not sure if the sharp drop in expected earnings for both years is finished. So much depends on as we see the success of the economy reopening and what unexpected issues may arise. The two inputs that should help support markets include historically low interest rates and, frankly, no great investment alternatives. Lower interest rates typically help the overall growth of the economy by encouraging the consumer to borrow, and also it is cheaper for companies to borrow to expand and meet that increased consumer demand. At the current rock-bottom interest rate levels in absolute terms, it also removes one potential alternative investment to equities for those investors looking for a decent rate of return on their investment. Other potential investments, including international equity, real estate, and commodities, do not have much appeal at the moment. These factors should place a floor on how low the market multiple will fall during this time of increased uncertainty and lower growth. Essentially, there's nothing else to buy. The trillion-dollar question is how to put a reasonable multiple on markets with such a large amount of uncertainty facing them. It is not unreasonable to think that the new normal market multiple will be lower than the 19 to 20 times earnings of the last 4 years, but the lack of attractive investment alternatives and low interest rates would help support markets to only drop the valuations to maybe the 16 or 17 times range. Using that thought process, taking the current 2021 S&P 500 estimate of $163 times 16.5 gives an estimated value of $2,689 for the S&P 500 on December 31st of 2021. The current value of the index is 2,857 or thereabouts as I type. The discrepancy shows that many investors believe that either 1. 2021 S&P 500 earnings estimates will rebound considerably in the next several quarters, or 2. The market multiple will be much higher than 16 to 17 times by the end of 2021. If expected earnings do not increase and we have continued uncertainty with the reopening of the economy, the S&P, unfortunately, will likely drop in price. There is a silver lining with the rebuilding of corporate balance sheets that will drag down earnings and market multiples for a few years. The good news is that we are building a very solid base to build on as we move from the end of this economic cycle and look to begin a new one. Less debt, more cash, and less competition, as the weak players and sectors have either gone bankrupt or been taken over by a stronger management team, should set the table for a strong stock market after we work through this mess.